This conference will now be recorded.
Okay. All right. Well, let's go ahead and get started. I'm going to leave the channel open, but if there's background noise, then I'll mute everybody, and we'll go through this information. Again, this is going to be kind of the basic stuff and then more commercial. Well, not as much commercial, just kind of touching on it, but we definitely want to dive into some stuff. I'm trying to change how I present, what I present, the material that I present. I get some feedback. People are really moving slow in the general insurance section of their exam. They're scoring a little low, so I kind of want to emphasize a little bit on that. Okay, so if anyone's new out there, if you have not registered yet, if you want to access my sample test questions and some additional information, here's the area to go. LGDstudy.com is just a landing page for registration. There's a PayPal link, but you can use any credit card. Choose the one you want. Click on the PayPal link. You can register there. When you do register, there's going to be an email response that goes to you. It's not automatic. It may take a little bit of time. I'm a one-man shop right now, so as soon as I get to internet, I'm going to send you the response with the login information. If you do have questions, there's my phone number. During the webinar, I'm not going to pick up any phone calls at this point in time, but you can also email me. There's my email, lauren@lgdconsulting.com. Even after you pass tests, I've got people still reaching out to me. If you have any questions out in the real world, by all means. Industry is a great industry and not a problem. You need some resources. You have a couple questions, need some help, reach out, not a problem. Okay? All right, so let's kind of break it down. Look at the title of the test you're taking. It's the property and casualty, or sometimes it's called the fire and casualty. All right, so it's interchangeable. Fire and property are interchangeable. Sometimes you'll see it on your question. It's a fire loss, it's a property loss, it's a fire policy, it's a property policy. It's the same thing. All right, but when you see fire and property, think of that's your stuff. That's your house, your car. On the contract, you'll see it as you and yours. So we, or us, the insurance company, are going to cover you and your stuff against a loss. And so you are the insured. You're the first party to a contract. You're the one purchasing insurance and protect yourself. The second party is the insurance company or the insurer. Right? Notice by changing one letter from insured to insurer changes the person, the entity. And so watch out for that. Right? Because they do kind of change it up periodically throughout the test. Just kind of throw you off. Okay. So the first party is the insured, second party is the insurer, right? The third party is anyone other than those two. So now the second half of this casualty portion over here, casualty coverage protects against a number of occurrences. And so this would be like their house, their car. In the contract, it would say we are covering them and their stuff. Okay, so, okay. And that would be a third party. Remember, if you're the insured, you're the first party. The insurance company is a second party. Anyone other than you two is a third party. And when you hear casualty, liability makes up the biggest area of casualty coverage. All right. And liability protection is anytime you see L for liability, I mean realistically associated with L for lawsuit. So L for liability is like L for lawsuit. You injure someone else, you damage someone else's property, and they're going to sue you to pay for the damages. That's what that's about. Okay. So again, remember that property and fire is your stuff. Casualty or liability is their stuff. Right? Keep the two separate. And so a lot of the questions when you're reading them, is it my stuff, which is a property claim, or is it I injure someone else, which is a liability claim? Right? So kind of break it down. As far as contract terminology, definition of insurance, multiple definitions. Right? Typically, you see it is a contract. All right. That's a one-word definition. Insurance is defined as which of the following: a contract. Right? It's a contract to restore you to what you had before a loss. Right? Or it's a contract to indemnify another against loss, damage, or liability arising from a contingent or uncertain event. Right? So the definition of insurance is a contract to restore you to what you had before a loss occurs, and that the loss must be uncertain. Right? So in insurance, we only insure uncertain losses. So if you know a loss is happening, it's too late to insure it. I mean, if the fire is already heading towards your house, it's too late to buy a homeowner's policy, okay, because that's a certain loss. So insurance contracts are contracts of indemnity. And indemnity means to restore you to the condition that you had prior to a loss, right, to make you whole again. So again, if it was a 3-bedroom, 2-bath house before the fire, well, after we rebuild it with the insurance, it'll be a 3-bedroom, 2-bath house just like it was. Okay. I do want to back up. So the definition of insurance is to restore you to what you had before loss. Right? The concept of insurance is to transfer risk. Okay. So be aware of that. So the definition is to indemnify you or restore you, but the concept is to transfer risk to an insurance company. You're paying a small known amount of money called premium for that large uncertain amount of loss called a claim. That's what that's about. Okay? All right. Now, next we have loss. Loss is defined as a reduction in the quantity, quality, or value of an asset. The loss doesn't have to be great. I mean, a dent on your fender shouldn't bankrupt you. Half the time, you don't even have to fix it. You probably drive around with that dent. But number one, it's going to cost you money to fix the dent. If you don't fix the dent and you sell the car, you're going to get less than what you thought you would have gotten because they'll point out that dent. And so there is a financial attachment to loss. Okay? And in order for it to be lost, there needs to be a financial interest or economic interest. Okay? So property loss, liability loss, and human losses are types of losses. But financial loss is not really, well, even though I said earlier, it's not really a type of loss because all of those cost you money. Let me explain. You're going to get a question that says, which of the following is not an example of a type of loss? And your answer is going to be property loss, liability loss, human loss, and financial loss. And most people pick human loss as the answer. And actually, that is a type of loss, and that financial loss is not, because human, property, and liability all cost you money, and that's realistically what it's about. It's not just based on finances. Okay. All right. In order to insure something or somebody, you have to have what's called insurable interest. Insurable interest is having a legitimate economic or financial interest in the preservation of the life or the property that is the subject of the insurance. Right? What that means is, in order to buy a policy on someone or something, if that someone or something suffers a loss, financially you're affected. So you can insure your house, because if your house were to burn down, it will cost you money to rebuild it. But you could not insure your neighbor's house, because if your neighbor's house burns down, financially there's no effect for you. In fact, if you could collect from the insurance, you would have made a gain, which is contradictory to what insurance is all about. It's there to cover the loss, not to give you a gain. All right. Now, in the property and casualty world, you have to prove insurable interest 2 times. Number one, at the time of sale or time of purchase, right? And number 2, at the time of the loss to collect. Right? But not in the meantime. So in order to buy the insurance, you have to prove insurable interest, and if a loss occurs, you have to prove insurable interest in order to collect. Okay. All right. Risk. Risk is defined as uncertainty of a loss. Okay. Everyone's going to get a question on risk. Now, there's 2 specific types of risk. We have speculative risk and pure risk. Speculative risk is associated with gambling. Gambling, you can win money and you can lose money. So there's a possibility of loss or gain. Well, that's a type of risk we won't insure. Remember, if you can get a gain out of insurance, we're not going to issue a policy. If we do issue the policy, we're going to limit what you collect. Right? So we insure pure risk only, right, which is loss only. Okay, the house burns down. What's the amount of the loss? That's what we pay. Okay? Now, once we determine there is a risk, there's different methods of managing the risk. There's 5 methods, but 4 are the main ones you need to understand. And the first one, methods of risk management, would be retaining the risk. Retention of risk is don't buy insurance. A loss occurs, you just pay for everything out of pocket. You may see it as retention of risk, retain, or you might see self-insure. Okay. A lot of people in California self-insure earthquake loss. They don't buy an earthquake policy. So if an earthquake totally destroys their house, they're going to have to foot the bill out of their pocket because they didn't buy insurance. Okay. Reduction of risk. All right. Number 1, drive within the speed limits. All right. It reduces the risk of major medical problems. It reduces the risk of having a loss because you're driving safely. Okay, for life insurance, I'm used to pitching life insurance. Quit smoking, ease up your drinking, exercise regularly, eat proper foods. You reduce the risk of major medical problems and possible early death. Okay. And another thing in California is instead of self-insuring earthquake, let's reduce the risk of loss by retrofitting the house. Okay. So we're going to basically retrofit it to support it to where it stands up when the ground shakes. The third one here is avoid risk. Avoid risk, well, you don't like earthquake, you don't want to live here, fine. Sell your house and move to some place where there are no fault lines. That's avoiding risk. Okay. Maybe getting rid of your car so you'll never get into an auto accident in your automobile because you don't have one. So that's avoiding risk. Maybe not participate in high-risk hobbies. Right? But transfer risk is what you want to focus on. That's what we're doing with insurance. Okay. Again, paying a small known amount of money called premium for that large uncertain amount of loss called a claim. Right? That's what transferring is about. Now, when we're transferring, we can transfer the risk by also sharing it. Okay, so I don't know. I guess a lot of your online studies, transferring and sharing kind of go side by side, but honestly, sharing to me is part of transferring. And when you're sharing the risk, you can go one of two routes. Okay, when you're putting the insurance into place, your insurance company may do something called reinsure. That means they take some of the risk and they share it with other companies. So the original company that you're selling insurance with is the primary or ceding company, and maybe the client wants more risk than they can handle, and so they're going to share the risk behind the scenes with other companies, and that's called the reinsurance. Right? And then we have co-insurance. So at the time of the loss, some people want to undercut and save money by buying less insurance, and so if they buy less than what the insurance company is requiring, based on their co-insurance requirement, they're going to actually have to pay more of the claim. All right. So there's two ways of the sharing. Like I said, reinsurance when the policy goes into effect, co-insurance at the time of the loss if you purchase less coverage than the insurance company is requiring that you carry. Okay. So here's the reinsurance world. Again, the first company you're dealing with, or the first company that the client pays premium from, or two, is called the primary, or sometimes called the ceding company. I'm not sure which terminology they'll use on the test. Know that, again, that's interchangeable. Retention limit. Every insurance company has a retention limit. The retention limit is the maximum amount of risk a company will assume on any one policy. And so the example would be here is a client wants $1 million worth of coverage. And the company that they're originally buying this policy from can only handle $500,000. That's what their retention limit is. Now, Department of Insurance sets that limit. So if the client wants $1 million, but this company can only handle $500,000, one of the things the company can do is just write two $500,000 policies to protect the client. That way it stays within the $500,000, and that first company manages the risk. Okay? Yeah, but the problem is with a client, that's two policies, two policy fees, two admin charges, so it's not necessarily cost effective. So the original company doesn't want to give up on that business, and so they're going to share it with other companies. Okay, and so here's what we have here. Company A picks up a little excess. I've got actually a little $2 million policy where the first company takes some of the $500,000, and then they share the rest with these other companies. Okay. Yeah, you can have as many reinsurance companies you have on, or you want on a policy, and a lot of times these reinsurance agreements or reinsurance treaties are in place before this company meets with a client. Okay, so if there's a major loss, this first ceding company doesn't go bankrupt because they handled the whole risk by themselves. They're sharing it and spreading the risk. So that's what kind of how it works. I sound a little jumbled here, so all right, I apologize. But the definitions you want to know is the original company dealing with the client is called a primary or ceding company. You need to know the definition of a retention limit. It's a maximum amount of risk a company can assume per policy, not per state. And it's not a minimum amount. Okay. That retention limit is based on capital, surplus, and reserves. If an insurance company wants to insure in excess of that retention limit, then they would have to go through reinsurance. Now, the agreement that the ceding company has with those reinsurance companies is called a reinsurance agreement and reinsurance treaty. And again, these treaties are set in place before even meeting with a client. All right, so when a customer comes through the door, they have an unusual risk or high risk, we know exactly which companies we're going to share the risk with. So, but that's all we're doing. We're sharing the risk. So if there's a catastrophic loss, not one company takes a hit. It's spread through the industry, okay, with multiple companies. Coinsurance, if you're going to get a math question, this is what it's going to be, okay? Very common. So the equation you need to know is how much you did have divided by how much insurance you should have. A lot of times you can simplify that fraction, and then you take it and you multiply it times whatever the loss may be. That's how much your insurance company will pay for your claim, minus any possible or sometimes called applicable deductible. All right. Keep in mind that the amount of insurance you did have is what you bought. The should is what is required by the insurance company. So it's not the value of the property in all cases. Right? Most companies require you to carry at least 80% of coverage to the value of the building. So the bottom number of that fraction typically should be 80% of the value of the building. If you put the value of the building as the bottom number of that fraction, you're going to come up with the wrong answer. Okay, so did divided by what you should have carried is 80% times the loss, right, minus any possible deductible. Now, sometimes this test may actually give you a specific deductible, like $1,000. If you read standard deductible, that's $250 on all of our products except for a business owner policy. On a business owner policy, the standard deductible is $500. Right? But a lot of times on these questions, it's actually going to give you a deductible. All right. So let's see this in motion here. An apartment house is worth $500,000. The owner insures it for $300,000. The policy has an 80% coinsurance clause. There's a $200,000 loss. How much will the insurer pay? And so what we want to do is we want to plug the numbers in the equation. And this is the equation you want to get down pat. Okay? And so here we have what they did have is the $300,000. So this is in the question. They should have had $400,000 worth of coverage. Remember, don't put the value of the building as the bottom number of the fraction. The company's saying there's an 80% coinsurance. That means the client should carry 80% of the value of the building. Okay, so that's going to be the 80% of 500 is the 400,000. So 300 divided by 400 times the $200,000 loss. Well, 300 divided by 400 simplifies to 3/4. 3/4 times the $200,000 loss is how much the company's going to pay, right? Which is $150,000 minus any possible deductible. Well, here we don't have a deductible listed, so we disregard that. And so the answer here would be $150,000. Okay. So get used to this equation. I'd probably write it down, memorize it, and as soon as you get to the test location, just take that scratch paper that they give you and just write this equation down right away. Okay. So, and again, if you go through the sample test questions on my website, exam 2, question 1, 18, A, B, C, D, I gave you 4. This one with these specific numbers is very common on the test. A lot of people came back and said they saw these numbers exactly. So I guess the repetition, you kind of don't need a calculator when you go in the test. You'll recognize the numbers and kind of know what to pick. Now, they may change it because one of the test questions have changed where they actually bought more than 80% of coverage. In this case, the example I have here, they bought less than the coinsurance requirement. Okay. But if they bought more than the value of the property or more than the 80%, then the full loss would be covered, just so you know. All right, so be wary of that one. Right. Solvency. Well, you want to work for a good, solid company. In order to be solvent, they have to have minimum paid-in capital, have surplus requirements, and also set up reserves. Now, reserves are liabilities. A lot of people think reserves are assets of an insurance company, but they're actually liabilities. It's money that's set aside to cover our current and future expected losses. Right? So based on the law of large numbers, we have to set enough money aside to cover our current and future claims. That's what reserves are. It's a portion of every premium is set aside in a reserve account, and that money grows and earns interest. That's what we use to pay claims. So that means we owe it to our policyholders when losses occur. That's why reserves are liabilities, not assets. Okay. Now, if you only have enough money to cover your outstanding liabilities, including reinsurance, you would be said to be insolvent. Okay, so to be solvent, an insurance company has to have all three: capital, surplus, and reserves. But if you only have enough to cover your liabilities, then you're insolvent, according to Department of Insurance. Right? And if you go insolvent, well, the commissioner's going to step in. First thing they're going to do, now remember, I'm using commissioner because I'm in California. It could be director or administrator, depending on the state. Right? They're going to come in and they're going to do everything they can to get your company back on its feet. So they're typically going to apply to the courts, be named as conservator, and do what they can to save your company, get you back on your feet. Right? Now, sometimes it takes the courts a while. And so conservation is the Department of Insurance applies to the courts to take over your company to get you on your feet. But if we can't wait that long, well, then we'll go a different route, and it's called summary seizure. Summary seizure is where they actually step in, take over your company, and do everything they can to get you back on your feet. Okay. Again, in both cases, conservation and summary seizure, we're trying to keep your company afloat to protect the consumer. Okay. If there's no way to save your company, well, then the commissioner, administrator, director now applies to the courts and will be named as liquidator, and that means to institute liquidation efforts. That means to close the business down. Okay. Conservation or getting your company back on its feet can be done either with or without court approval. Liquidation can only come through court approval. Right. And then they're going to contact the Guarantee Association. Here we have the California Insurance Guarantee Association. Each state has their own. It's kind of like member FDIC. Okay. At a bank, if the bank goes under, you're guaranteed $250,000 per account. Guarantee Association protects their claimant or policyholders if they suffer loss at the same time that the company goes bankrupt. Okay. All right. Now, under the Guarantee Association, if your company goes bankrupt and you suffer loss, the minimum claim you can even request is $100. All right. The maximum obligation that they'll pay is $500,000 per claim. That means if you have a $3 million property and that property is destroyed by a fire at the same time your insurance company goes bankrupt, the maximum you'll get to rebuild your $3 million property would be $500,000. Okay, so let me go back. Mark, I think I passed that up. Yeah, it's $150,000. Oh, sorry. Okay. All right. Now, when you're selling insurance, this last line, make sure you follow. You cannot use the existence of the Guarantee Association as an enticement or inducement for the sale of a policy. That means you can't say, hey, you should buy from our company because we're backed by the Guarantee Association. Every admitted insurer has to be a member and pay into it. Okay, so any insurance company in your state that has a certificate of authority is required to be a member and pay into it. All right, so you can't say that your company is special. And you can't sell policies saying, hey, the reason I'm selling for this company is if we go bankrupt, you're fully covered. Well, you're not. The minimum claim is $100,000 and the maximum is $500,000. So if your property is worth more than that, you're not going to be fully covered. So it's misleading. And so the Department of Insurances basically say in advertising, marketing, and selling your products, do not use the existence of the Guarantee Association to entice people to buy from your company or you. Okay, so insurers, location, domestic, foreign, or alien. Domestic means the insurance company originated in the state that you're in right now. Okay, again, we're in California, so if an insurance company originated or organized in the state of California, we would call them a domestic insurer. So if we're dealing with an insurance company that originated outside the state of California, they would be foreign. So here in California, right, we have some companies here. Farmers originated here in California, but New York Life is based in New York. So here in California, New York Life would be a foreign insurer. They originated outside the state of California. And if your company originated outside the jurisdiction of the United States, they're called an alien insurer. So remember, domestic is within your state, foreign is outside of your state, and alien is outside of your country, our country. Okay. Now, it doesn't matter where you're from. In order for you to openly, actively sell in the state, they have to achieve or require, or I guess, pick up a certificate of authority. And then they would be classified as admitted, or sometimes you'll see authorized, means they're authorized to transact. Okay. So they basically, this is your insurance company's license to openly, actively sell their products in the state. If your company does not have a certificate of authority, either because they couldn't comply or they just didn't care to comply to get a certificate of authority, then they would be classified as non-admitted. Okay, so admitted means they have approval, have a certificate of authority to transact in California. Non-admitted, I'm sorry, in your state. I'm sorry, I keep getting it squared away. So some people from other states, so I apologize. Okay, non-admitted means they do not have a certificate of authority to transact in your state. So please keep in mind that domestic foreign alien and admitted and not admitted are two different things. Domestic foreign alien is where does your company originate from? Admitted, not admitted means wherever they're from, did they get approval to sell in the state? Okay. Now, in buying from a non-admitted company is not necessarily a bad thing. You may get a test question as far as where would you find a list of reputable non-admitted companies, right? And it's called the Leslie list. Leslie, L-A-S-L-I, list of approved surplus lines insurers. You may get that on your exam. So it's not that they're approved, that they're admitted, they're just reputable non-admitted insurance companies to place business with. That's what the Leslie list provides. L-A-S-L-I, just so you know. Okay. We had a couple of people get some feedback that they saw that on their test. So, okay. As far as types of insurers, this is also on the other webinars that I have posted. The two biggest insurers, which, by the way, on your exam, you'll see commercial insurer. And whenever you see commercial insurers on the exam, like I said, that's going to be your mutual and your stock insurance companies. And as an insurance company, you got to get off the ground. You got to raise money. So where are you going to raise capital to get your company off the ground? Well, with a mutual company, you raise money by selling policies. A stock company, you raise money by selling stock to investors. Right? So if you bought a policy from a mutual company, they're going to offer you what's called a participating policy. So in raising money through policyholders, when you buy a policy, in a sense, you have ownership in the company. So if the company makes a profit, they're going to share that with you in the form of a dividend. Okay. And so when you hear mutual company associated with participating, that you, a policyholder, participate in the profits of that company. Now, when they pay that dividend to you, the policyholder, it's actually defined as a return of excess premium paid. And so therefore, dividends are tax-free to a policyholder purchasing a policy in a mutual company. So you're using after-tax money to pay for the policy. We did very well in our investments and our expenses and our accounting, that we made some money. We're going to give it back to you. Return of, you paid too much premium in a sense, okay? So it's non-taxable, and we're going to call it a dividend. So now in a stock company, if you buy a policy from a stock insurance company, you just bought a policy. They're called non-participating policies because you do not participate in the profits. See, if the stockholders, shareholders, basically provided the money for this company, then any profits are going to be diverted to the owners of the company, which is the stockholders or shareholders. So you do not participate in the gains of the company if they do well. All right. So now when we pay the dividends to our investors as stockholders, that dividend is going to be taxable because it's investment return. Right. So these are your biggest competitors on the market. Right. It's easy to tell which one's which. Just look at the first page of the policy. It tells you. ABC Company is a mutual insurance company or a stock insurance company. Right. Don't look at the name. Okay. Because Mutual of Omaha. I'm sure some of you probably recognize that name. They're actually a stock insurance company right now. Okay, they did on the bottom left-hand corner of the sheet. They did something called demutualization. That's where this mutual company has converted into a stock insurance company, so they became publicly traded. Okay, they still keep the name Mutual of Omaha because it's got good name recognition in the marketplace, but they're actually a stock company. And so you may get that question on your test when a mutual company converts to a stock insurance company. This is known as which of the following? Demutualization. It's a rare question, and it's rare, even more rare in the real world, that a stock company drops down to a privately held mutual company, but it is called mutualization if you get that question. Some other types of insurers, whenever you hear fraternal, think of businesses that engage in charitable or benevolent activities. So look for nonprofit. And again, you probably won't see nonprofit. You'll see charitable or benevolent activities. Well, charitable should be nonprofit. That's what you want to associate that with. Reciprocal or inter-insurance exchange. We are exchanging insurance among ourselves is what this basically is. There's key words here. Number one, unincorporated. So a reciprocal insurer is typically unincorporated. They're going to use an attorney, in fact, right, to set up agreements between all the members. The best way to understand this is I equate this to a homeowners association. So if you live in this area and there's a homeowners association, you're going to pay dues to the association. Everyone actually pays dues into their own individual account. If somebody's fence blows over that affects a couple people's yards, the board of directors of this association, which you voted for, is going to figure out, well, how much is it going to cost to fix the fence? And why don't we just dip into everyone's account equally to pull the funds to fix the fence? So in a sense, you're all insuring each other. That's how a reciprocal or inter-insurance exchange works. Right? Everyone pays premiums into their own account. Instead of a board of directors like a homeowners association, you vote for an attorney, in fact, to make decisions on behalf of the company. But you're all insuring each other is how you want to understand that. Okay? Lloyd's of London is an insurer, but they're not an insurance company. All right? So it's providing more of a meeting place, kind of a physical location for buyers and sellers of insurance to get together. Okay? You join a syndicate, and your syndicate then enters into contracts. Right? So one of the oldest insurers that's still out there, they used to advertise they insure anything, but they kind of dropped that. They don't do life insurance. Okay? But again, they're more of a physical location where buyers and sellers of insurance get together. So to me, it's like a rich kid's playground. I mean, you've got a lot of money, nothing to do, kind of bored. You go to Lloyd's of London, you join one of the syndicates, and then you actually enter into insurance contracts. So you're your own insurance company under the Lloyd's name. Right? So you go there, you sit in one of their cubicles, join one of the syndicates. There's about 150 different syndicates. And like I said, you enter into contracts. Excuse me. So Mariah Carey calls up saying she wants a $1 billion policy for accidental injury to her legs only. You get the call. You're going to talk to Lloyd's actuaries and underwriters and say, hey, what do I charge? They're going to give you a number. And so you get back on the phone and you say, hey, Mariah, I'll take this much premium to cover your legs for accidental injury at $1 billion. And she says, I'll take it. And so she pays you this premium. Some of that premium you're going to give to Lloyd's of London because you're using their facilities, their actuarials, their underwriters. The rest of that premium you're going to invest. Because if Mariah Carey gets into an auto accident, her legs are dismembered or maimed, you're going to have to pay that $1 billion out of your back pocket. So you're the insurance company under the Lloyd's name. Lloyd's just provides the facilities and, of course, the actuaries and underwriters to assist you. Okay? So, but that's kind of how you want to know it. Right? Risk retention group, think of a reciprocal, but they deal more with liability coverages. Okay? And of course, most people don't realize that the government is also an insurer. At the state level, we have unemployment insurance. Right? At the federal level, we have unemployment insurance. But at the federal level, we also have Social Security. At the state level, we have workers' compensation. Okay? So, I mean, the government provides insurance. I mean, look at Social Security. Your premium is the 7.65% that comes out of your paycheck, right, that your employer has to match every quarter and send off to the IRS for your Social Security taxes. That's premium to give you benefits from the U.S. government, which is retirement, survivors, disability, and Medicare. Okay, so yeah, the government provides insurance. The government a lot of times also steps in where private insurance companies will not touch, like national flood, nuclear risk, things like that. Okay. So now let's dive into the parts of an insurance company. We have the actuarial department. These are your statisticians. They're the ones who do all the research and set the rates for the underwriters and you, the agents, to charge for the risk. They have to set the rates where we charge enough to cover losses, cover expenses, make a profit so it's worthwhile to stay in business, but we cannot overcharge where we're not competitive in the marketplace. That's a real thin line. That's what their job is. Their job is to keep the insurance company financially sound or financially stable. The underwriting is a risk selection process. The underwriters gather as much information about a prospective insured and makes a determination, do we want to insure them, and if so, what are we going to charge them? Their job, along with your job, is to protect the insurance company from something called adverse selection. Adverse selection exists when you have a bunch of high-risk people trying to seek and get insurance coverage more often than a normal risk would. That's what that's about, and you help with that. An example would be someone who got into an auto accident today. They don't have insurance, right? They talk to an agent. They get the auto policy later on today, and then they file the claim tomorrow saying the accident just happened. Okay, things like that are going to cost the insurance company more money. All right, and so we got to do the best to protect against that. All right. Another good example, probably a better example, someone who has liability coverage for 5 years with you, and then all of a sudden they call you up and say, hey, I want to add physical damage coverage to my vehicle. You say, not a problem. Swing it by the office. Let us take a look at it, and we can add it on. And they're adamant. We can't do this over the phone. No, we actually need to take a look at the car. Okay. I'm like really busy. I'm like actually flying out of town tonight. I mean, can we just do this over the phone? To me, it's like, well, what's going on here? Something just happened, and now you want to buy the insurance to cover something that already happened. Okay, and we're not going to cover that. All right. Next one, marketing and sales. This one is like a really easy question. The marketing and sales division of an insurance company is responsible for which of the following? The answer is marketing and sales. Okay, and it's such an easy question that people look at it and think it can't be that easy, and they want to pick something else, but don't. Some questions are that simple, that straightforward. Claims is where we investigate, settle, and pay claims. Working with the claims department, we either have an insurance adjuster, which is typically an employee of an insurance company, to assess the damage at the time of a loss, and a public insurance adjuster, which represents the public in dealing with a claim. Okay. But again, these are people that assess and put a dollar amount to the loss that was suffered. So these are just some parts of an insurance company you need to be familiar with. You, the agent, you're part of the underwriting process. You do what's called pre-selection underwriting. Your job is to look at this house or this business, and is this something we're willing to insure? Okay? And so if it fits in your company's guidelines, well, then you can submit the application. And then the insurance company underwriter does what's called post-selection underwriting. All right, so you do pre-selection, is it worthy? You submit the application, and then they do more of a background check. So I always tell my new agents that I train that don't use the word quote. And I use it here and there in my training, but in the real world, don't use the word quote. Because if you quote them $100 and then it goes to underwriting and they say, well, they've got some issues here, so we're going to charge them $250, your client gets upset at you. Well, you told me it's $100. You quoted me $100. Why is it $250 now? You see what I mean? So avoid the confrontation. Now, let me put together a proposal for you. Let me give you a couple options. Let's submit it to underwriting. Let's see what they say. Okay. So less impactful if the price comes back higher and you got to go back to that client. And that happens sometimes. Now, when a loss occurs, well, how much are they going to get? And how is it paid out? So this is called the valuation clause. So it determines how do we value the loss at the time of the loss. Okay. So replacement cost is replace, restore, rebuild, reconstruct, brand new. So typically on your homeowner's policy, we're going to replace it brand new. So again, if it's a 3-bedroom, 2-bath house, it burns down, what is it going to cost to rebuild the exact same 3-bedroom, 2-bath house? That's what replacement cost is. Actual cash value would be taking replacement cost minus depreciation. Okay? And so that big screen TV, what does it cost brand new today, minus depreciation because you've had that TV for a couple of years. Okay? And so we kind of give you what's called the used value. And this is what we typically will do for your personal property. So we cover that house on reconstruction costs or replacement costs, but all the stuff in the house we typically cover on an actual cash value basis, like your clothes, your furniture, your pots and pans. Okay. Now, the tricky part is a lot of people, they get used to word association, and whenever they see depreciation, they pick actual cash value. But if you notice this third bullet, if I take replacement costs without the deduction for depreciation, well, then that would still be replacement costs. All right, so don't just, if you see depreciation, don't just pick actual cash value. I mean, read the questions carefully. Your test does little things like that, throws people off, especially those people that try to memorize keywords. It doesn't work sometimes. All right. Market value is what would you get for it if it were sold? Like if you totaled your car, let's find three people selling the same car as the one you just totaled. We'll take the high, the low, the mid, we'll average it out, and that's what we're going to pay out. Okay. So like if you sold the car one day before you got into an accident, what would you have gotten for it? That's what the market value would be. The stated value or valued policy, this is typically going to come into play when we're thinking about fine arts, antique cars. Okay, where you and the insurance company, well, based on appraisals and maybe some other items, pick a stated value that if a loss occurs, this is the maximum we're going to pay. If it's less than that, we'll typically pay actual cash value up to that stated value. All right. An example would be you have a unique painting, right, and we'll say it's worth $100 grand. Okay, and 1/4 of the painting is destroyed by a fire. It's not a total loss because only 1/4 of the painting was destroyed. But we really cannot replace 1/4 of a painting. And so we're going to pay actual cash value up to the stated value. So in a partial loss, you may actually get a full payout. Okay, that's where that comes into play. All right, cause of loss. First things first, a peril is defined as a cause of loss. There's different types of perils, fire, explosion, flood, cancer, AIDS. Those are common perils. They cause loss. Now, when you hear cause of loss forms, these are forms that list perils. And so we have named peril forms like basic, broad, and earthquake. Right? That means we list perils that the policy will provide coverage for. If you see open peril, sometimes called all risk, sometimes called special form, we list perils also, but we list perils that are excluded from coverage on this particular policy. And so named perils list perils we cover, and open peril policies list perils we don't cover. All right? And so open peril, all risk, or special forms have what we call the broadest coverage because you can only list so many exclusions. If it's not on the exclusion list, it's covered. But the named peril form, we can list perils, we can list quite a few, but anything that happens that is not one of those perils on that list won't be covered. So let me give you an example. Let's say a satellite falls on your house, so falling satellite. Okay. Well, you look at the basic and broad form, and if it doesn't say falling satellite specifically as a peril, it won't be covered. But then if we go to the special form, and if we don't see falling satellite as an exclusion, then it would be covered. Okay. And so they're opposites. Named perils list perils we cover. All risk or open forms, open perils list perils we don't cover. All right? So you got to know the difference because you're going to get this topic in a couple different ways, multiple times on the test. All right? And then on the right-hand side, we have hazards. Hazards are conditions that would increase the likelihood of a peril occurring. So a hazard, like I have here, is like a catalyst to a peril. See, a peril would be an auto accident. A hazard would be you have badly worn tires where you're more likely to have an auto accident. So you see how it increases the likelihood that a loss may occur. The badly worn tires I've described, that would be an example of a physical hazard, something structural, something tangible. Living next to an explosives factory would be a physical hazard. There's other types of hazards. We have moral and morale. And I've got it kind of highlighted there. Moral ends in an L. L is for lie. Someone who has a tendency to lie, cheat, be dishonest. That's a moral hazard. Morale ends in ale. And when you drink too much beer, you kind of get careless and clumsy. And so that's how you want to understand morale. Indifferent attitude, someone who's careless, right? They drive fast, they engage in high-risk hobbies, okay? So that's kind of a careless mindset. The test will typically use indifferent attitude. Right? And then we have legal hazards. You hear stories of this, people that are going for more money than they're legally entitled to. It's a 5-mile-an-hour stop and go traffic going home, and someone gets bumped. a little 5 mile an hour bump, and they're claiming soft tissue damage and trying to sue for $2 million. There's not even a scuff on the bumper to show that they got hit, and they're trying to sue for $2 million. Now, a lot of times the insurance company won't even defend this. They might just offer a settlement, which is great. If this person takes that settlement and the claim is over, they go away. The problem is, where do insurance companies get the money to offer that settlement? That comes from all of us paying higher premiums. So legal hazards, those people that are going for more money than they're legally entitled to, we're all paying for it with higher premiums. Okay, so those are hazards, and that's how they relate to perils. So how perils interact? There's a little bit more with the peril situation. We have what's called concurrent causation. This is where you have two perils act in tandem. One is covered, one's not. Both of them would be covered under concurrent causation. So an example I'm going to use here is you have a standard fire policy. A standard fire policy only covers three things: fire, lightning, and a situation called removal. Yeah, it's more of a situation than a peril. Your house is on fire. You want to remove some of the stuff out of the house to protect it from the fire without endangering yourself. And so removal means moving your property to another location and protect it from further loss. Okay. So now, that's all this policy covered: fire, lightning, and removal. So let's say lightning strikes your house. A lot of times lightning causes fire. And with the fire, the firefighters come out and they dump a ton of water on the house to put the fire out. But now we have water damage. Now, in a standard fire policy, water damage is not listed as a peril. Therefore, it typically would not be covered. But fire and water damage kind of work together. To put the fire out, we use water. And so you have two perils. One is covered fire, one is not, which is water. Since they work together, both would be covered. That's what concurrent causation is all about. Now, wait, there's more. Concurrent causation exclusion. Again, we have two perils act in tandem. One is covered, but one is specifically excluded. Well, then neither would be covered. Okay, so let's go to an HO5. An HO5 is an all-risk form. And anytime you see all risk, you want to pay attention to exclusions. And one of the exclusions is going to be earthquake, specifically listed as an exclusion. Right? Lo and behold, an earthquake rumbles through, causing your house to collapse. Okay, so you have two perils working together. One is covered, collapse, because that's a covered peril under your HO5, and one is specifically excluded, which is earthquake. So even though one's covered, since the earthquake caused a collapse and earthquake is specifically excluded, neither would be covered. Okay, so you wouldn't have any coverage for that particular loss. The only exception to that is the bottom right-hand corner is fire and explosion. So if earthquake or flood in some way, shape, or form cause fire or explosion, your insurance company will actually pay for the fire and explosion damage. Okay, and that is represented in a possible test question you may get, where an earthquake destroys a building. During the collapse, there's an explosion of the gas line causing fire damage. And so it's determined by the adjuster that 50% of the loss was caused by earthquake, 25% of the loss was caused by the explosion, and 25% of the loss was caused by fire. How much would the policy pay? And the policy would pay 50%. It's only going to pay the 25% fire and 25% explosion part of that loss. Okay, so and that's where that comes into play. Okay. All right, now that's dealing with perils. Now we have policies, concurrent policies. Concurrent policies is you have two policies on the same property with exactly the same perils. All right. For some reason, I don't know why, maybe about two policies on a property and the perils are exactly the same. That's called concurrent policies or concurrent coverage. Actually, you'll see concurrent policies on here. Now, if you have two policies on a structure and the perils don't exactly match, then that would be non-concurrent policies. And so you have a broad and a special form. You have a commercial property with broad form and a commercial property special form. These two policies are on the same building, and the perils don't match exactly. That's just said to be non-concurrent policies. Okay. So, a little stuff. These are some rare ones, but just to make you aware of it, I wanted to present that. If a loss occurs, well, how do we pay? What do we pay? All right. So we have specific damage awards. So when you hear the word specific, think of it's specific. You get a ding in your fender, we know exactly what it costs to bang out that ding or replace that fender, which includes labor. All right. What falls under the specific category is something called special damages. And whenever you see special damages on the exam, think of lost wages or lost income. And so you had to miss work for 8 days. Okay, great. Well, that's special damages because it's lost wages. Right? And it's part of specific because this is how much you make a day times 8 days. That's what we're going to pay. So specific and special is we know exactly how much the loss is. General is the non-specific. That would be the like mental anguish, pain, and suffering, okay, where we really cannot put a dollar amount to that loss. Right? Even for mental anguish, pain, and suffering, even the juries may use a multiplier. Right? So it could be a multiplier of what the specific damage was awarded, and that's what they'll pay for mental anguish, pain, and suffering. Okay. Punitive damages is where we're going to set a financial example to the industry. I always go back to Stella and her little coffee. When McDonald's first brought out their hot coffee makers, hot coffee machines, I mean, the coffee was extremely hot. And, Stella went through the drive-through window, ordered a hot coffee. They handed it through the window. Either she grabbed it wrong from the top, because usually they hand it from the side of the cup, and when you grab it in the drive-through, you grab it from the top around the rim. And maybe the lid wasn't on right, or she didn't get a good grip where it just dropped right out and just landed in her lap, causing second and third degree burns. And all she wanted to do was have her medical bills paid, and McDonald's denied it. So she sued him only for her medical bills and lost. So then she appealed it and got an attorney who got the press involved and threw in $2 to $3 million in punitive damages. Now, the punitive damages is basically setting an example to all these fast food restaurants that you have to be cautious in selling your hot drinks through the drive-through window, that if a loss like this occurs, you might have to pay these types of claims. And so you need to do something to keep that from happening. So what happened is, well, number one, they turned down the temperature of their coffee machines. Right? Number two, there's disclosures everywhere. Caution, our hot drinks are served hot, right? Caution, hot. And that's their way of, warning people. Okay, but that's what that was all about. So punitive damage is viewed as a monetary, slap on the hand, and it's also, making them an example to the industry to keep this from happening. Okay. All right. So there's some of the general items, maybe a little bit more than what I had in previous webinars. Put that in there. So now we'll jump into the commercial modules. Now you see a commercial property or commercial package policy, but sometimes you'll see commercial modular policies. So these are the different coverage parts, or like I said, sometimes on your test they're called modules. And we're going to do a whip through of all of them except for farm. Farm, it's kind of a blend of residential and commercial one program. It is listed on the commercial side. Farm is not only you live there, you work there, so the house is covered. The other structures are covered on a co-insurance basis. Farmer John's tractor would be covered as farm equipment, farm machinery. But remember that Farmer John's pickup truck that he drives to the store for groceries would be covered under Farmer John's auto insurance. So keep that separate. Okay. Typically not too many farm questions that most people will get. So I just kind of want to pass through that. Okay. So the first one, we have the commercial property coverage. Now, we typically have three cause of loss forms: basic, broad, and special. Those are the ones that you're going to see on dwelling and homeowners. But for commercial, we also throw in earthquake. Okay, so for commercial property policy, you can buy earthquake as a cause of loss form. You can also buy earthquake as a separate policy, and every once in a while, you can actually buy earthquake as an endorsement to your commercial property program. All right. And so, basically covers the building, right? Covers the stuff in the building, which we'll get into. Valuation. If you suffer loss, what do we pay? Well, for commercial property, it's actual cash value on everything. So actual cash value on the structure, actual cash value on your contents. Keep that in mind, because for dwelling and homeowners, we typically pay replacement costs for the structure, actual cash value for contents. In fact, even a business owner policy, we pay replacement costs for the structure, actual cash value for contents, right, or business personal property. But for commercial property, it's actual cash value on everything. Okay. There are 13 coverage forms you can get. I actually have a commercial property webinar posted on YouTube, so you might want to take a look at that. I kind of pulled a little bit from that, and we're going to throw it here. As far as the property coverage form, coverage A would be covering the building. Anything bolted, welded, nailed, attached to the structure would be coverage A. Insurance companies want you to carry at least 80% of coverage to the value of the property. That's that 80% co-insurance requirement. Remember, this co-insurance is an encouragement to carry adequate limits of coverage. And for commercial property, if you carry 80% of coverage to the value of the building, you get 5 free extensions. Now, that's the difference between an endorsement and an extension. Endorsement's typically additional charge, right? An extension is free on your commercial property policy as long as you carry at least 80% of coverage to the value of the property or the value of the building. The extensions are newly acquired or constructed property. You get $250,000. This is a common one. And so, when you buy a new car, you have some time to notify the insurance company to add the new car on, but in the interim period, you still have coverage. Okay. Same thing. How about if you bought a new building or a building that just got finished at completion and you're working out the insurance details? You're automatically provided with $250,000 of coverage on that newly acquired and constructed property. You're also getting covered for $100,000 of business personal property in that newly constructed or newly acquired property. All right. You get $10,000 for property off premises. In a commercial property policy, it typically will only cover you and your property in and around the building within 100 feet of the premises. So if you extend that 100 feet from the premises world, there's no coverage. One of the extensions is we can give you up to $10,000 for business personal property off premises. Okay. If you have a sign, it's attached to the building, we give you $2,500, and there is some limited valuable papers and records coverage also. Now remember, this is more associated with the building. All right, the stuff in the building that's coverage B is business personal property. And then you have coverage C, which is personal property of others. So let's say you have a veterinary hospital, and you have other people's pets that stay with you overnight while you're taking care of them. And lo and behold, there's a fire that destroys the building, including your customers' pets. All right. We're going to replace those pets on an actual cash value basis. So remember, because I said commercial property coverage, we pay actual cash value on everything, the building, contents, and personal property of others. Okay. Now you might see Bailey's coverage. It would be personal property of others, like a dry cleaner where they have temporary possession of other people's property, like shirts, laundry, things like that. That'd be a dry cleaner. That would be a type of Bailey's coverage. Okay. More on that we'll get to a little bit later. So if you own a building, it's great. You want to protect it in case it burns down, but you also have to protect your business in case something happens to your customers. And so we have general liability, sometimes called commercial general liability, CGL, or just general liability. All right, we have 3 coverage parts. We have coverage A, which is bodily injury and property damage to others. So this is you injured a customer or you damage a customer's property. That's because, remember, liability is covering them. Coverage B would be personal and advertising injury. So you have an advertising campaign on TV which knocks your competitors and they suffer financial losses and they actually sue you. That would be covered under coverage B. And medical payments, of course, would be to other people also, because since this liability, this covers others. Your employees are covered under workers' compensation. This only covers your customers. All right. Now, this covers on-premises and off-premises, right? In some cases, right? There's 2 aggregate limits, which I need to add that in here. It's on my other webinar. Your commercial general liability policy has 2 aggregate limits. If you look at the deck page, it's going to list the premises and operations aggregate limit. That'd be like a slip and fall in the building. That would be the first aggregate limit. Now, an aggregate limit is defined as the maximum that your policy will pay for all claims during a policy period. Right? And so there's one aggregate limit for premises and operations like slip and falls. And there's a separate aggregate limit for products that left the premises and a loss occurs away from the location of the business. That's called products and completed operations. So you manufacture toys, right? People shopping in the lobby of your company, they can buy toys on site. And someone slips and falls, that would be the premises and operations liability. then someone buys a toy, they take it home 2 years later, it malfunctions and injures their child. That would be products and completed operations aggregate limit, because that loss occurred away from the location of this business. Right? That's what that's about. Right? Most of your other policies, there's only one aggregate limit, but this one has two. There's two ways of writing commercial general liability. We have occurrence-made coverage, and we have claims-made coverage. Okay? And again, that's going to be on the other webinar, and I will be bringing out some additional webinars sooner, pretty soon actually, which is going to explain this a little further. So it can be confusing as far as the two ways of writing it. Okay. All right. Next step, we'll go to commercial crime. Someone can steal your stuff. Now we have different coverage parts. Right? The first one here, coverage A, is employee dishonesty. This is actually a fidelity bond within the commercial crime program. Right? And so you may get a question that says, which of the following provides coverage for employee dishonesty? Now, I really want you to search for fidelity bond first, because fidelity bond is specifically for your employee stealing from you. Okay. If you don't see fidelity bond, your next best guess would be commercial crime covers employee dishonesty. It's actually a fidelity bond within the commercial crime policy. Coverage A is actually a fidelity bond. Okay. So coverage A would be if your employees do anything wrong. Coverage B would be some outside party gets a hold of your checks and money orders, forges, alters them, and sends them to other people. Now, I emphasize it's an outside party that gets a hold of your company's checks, money orders, forges, and alters them, and sends them out to other people. It doesn't cover your employee doing that, because if your employee got a hold of your company's checks, money orders, forged and altered them, and sent them out, that would be coverage A, where your employee did something wrong. So coverage B is an outside party. Coverage C is theft of money and securities from outside parties. Because if your employee stole money and securities, that would be coverage A. Coverage D would be theft of property other than money and securities. So that would be some outside party stealing your inventory. Again, it's an outside party, because if your employees were stealing your inventory, that goes back to coverage A, your employee was dishonest. Okay. So remember, coverage A is your employees, coverage B, C, and D are other people. And there's two ways of writing commercial crime coverage. We have loss sustained and discovery form. Okay, and again, that's on the other webinar. I will add little bits and pieces. I'm trying to condense some of my webinars, get them a little more focused, and little by little, I'll be presenting those. Okay. All right, next section we have commercial auto. Just like your personal auto, coverage A is liability, and that's basically where you want to start. In case you hit something, right? Liability covers the people you hit, either the people or the property that you hit. Coverage B is medical. That's typically for you and your passengers in your car. Coverage C is uninsured motors, where you and the passengers in your car are hit by someone who doesn't have insurance. This is the only liability that pays you and people in your car that are injured because someone hit you and injured you, and it's their fault, but they don't have coverage. Now, in commercial auto, medical and uninsured motorist is optional. Okay. The reason is typically if you're going to give a company car for your employees to use, the only people in that company car should be your employees. Okay, and your employees are covered by workers' compensation. So coverage B and coverage C of your commercial auto policy typically wouldn't apply and typically wouldn't be needed. Okay, and so that's what that's about. So again, coverage B and coverage C are optional for commercial auto. Coverage D is physical damage. Right? We have collision in case you damage your car because you hit something. We have comprehensive coverage, which something damages your car that's not related to collision. And then we have a really limited type of cause of loss form for your autos, would be specified cause of loss. And so it's kind of a very limited named peril type of coverage for your company cars. Comprehensive, of course, has the broadest coverage for your company vehicles. Specified cause of loss has the reduced limited coverage for your vehicles. So just in case you get that. And commercial auto, remember, we use symbols. Right? Just putting a symbol next to that VIN number tells us what type of coverage we have and what type of car that is. Right? The next step, we have inland marine. Now, inland marine is listed as all risk, or covers your property on an all risk basis. Think of expensive items compared to Bailey coverage. Remember, Bailey's coverage would be your dry cleaners, okay? Which, shirts, you can get shirts at a pretty decent price. But inland marine would be like jewelry that are leaving with the jeweler to be clean size, refitted, maybe a new stone put in, okay? More expensive items. Covers camera, musical instruments, right? Valuable papers and records coverage, things that aren't covered by the other programs, or you want them covered at a higher limit. Right? It can be scheduled or unscheduled. Sometimes your test may say filed or unfiled, non-filed, I should say. Scheduled means I need a list of what you have. Right? Unscheduled means I don't need a list, but you definitely got to show proof of loss. The key words here are the 3 C's: care, custody, and control of other people's property. So you have a jewelry store. You have a commercial property policy covering your store, the structure, the contents like your displays, right? And some of your lower end jewelry, but then you're going to have inland marine to give you better coverage on your high end jewelry. And every once in a while, working in a jewelry store, people will drop off their jewelry to get it clean, size, refitted, maybe a stone change out, whatever it may be. Okay, and so you have temporary possession of other people's property under your care, custody, and control. And that's kind of how you want to know inland marine. The expensive items like furriers, like fur coats, like I said, jewelry. Covers things used on a set, like a movie set, like scenery props, costume jewelry, right? And things like that. Equipment, mobile equipment like bulldozers and things like that, which is more expensive than other areas where you have inventory for sale. This is covering the expensive items. Now remember, inland marine covers the bulldozer or a forklift or a Zamboni. That's what we call mobile equipment. That's non-street legal vehicles, right? But liability covers what you hit with that forklift. So let's say you're driving a forklift out in a lot and you lose control and you drive into a neighboring company's the side of the building. Okay, and so inland marine covers damage to the forklift, but your commercial liability would cover damage to the neighboring company's building that you drove the forklift through. So kind of when one coverage ends, the other one can pick up if you have all those coverages. It is better to buy your commercial coverages in this package with one company because you get discounts. There's fewer gaps and no overlaps in coverage, so it's a little better to package it all up with one company. It's cheaper, like I said. One more coverage is boiler machinery. Okay. And so your commercial property policy covers the structures, but it won't cover boilers or machineries below the surface of the ground or below the lowest basement floor. This kind of covers things that aren't covered anywhere else: steam pipes, steam turbines, generators, things like that that aren't covered by your commercial property policy. Boiler machinery is covered on an all-risk basis. Whenever you see all risk, always pay attention to exclusions. And one of the biggest exclusions that we will not cover anywhere in insurance is wear and tear. Kind of like intentional acts, not covered. Boiler machinery covers items on a replacement cost basis. So remember, your commercial property policy pays actual cash value, but boiler and machinery coverage can be added to that, and it basically covers your boilers and machineries on a replacement cost basis. Most of your premium goes towards inspections to prevent loss. All right. So again, we do inspections, replace out worn-out fittings, keep from an explosion occurring. That's more cost-effective. All right. So that's why I call them loss inspections, but there's more inspections to prevent loss is how you need to understand that. Okay. This would be equivalent to a home warranty when you buy a house. You get this home warranty. One of your appliances breaks down. Washing machine, electrical, plumbing. You pay someone a deductible, they come out and fix it. You want to view this as kind of the same thing, but for a business. Right? And so those are the commercial coverage parts. Right? And that's kind of more of a summary here. I have a little more expansion of this material on my other webinars, but I will be bringing out some additional webinars as time goes on. So what I want to do is go ahead and open up to if anyone has questions. Then let's dig in here. I'm still recording, right? But yeah, if you have any questions, what can I do to help you out? Mark, any questions?
I do have a question, but I've got to like look it up on the material you provided with the test questions.
Oh, ask away. What is it? Do you know, or what was the question about?
I don't know. I don't know offhand. I got to look at it again really quick, but I knew I had something about I wanted you to explain.
Okay. If you dig into it, just email me then. Not a
Yeah,
problem, or give me a call.
yeah, that sounds good.
Got it. When are you taking the test?
We're looking at the 28th of September.
Okay. You got plenty of time.
Yeah.
And how many times have you gone through my exams?
Um, a few times, but I need to really do it again. I guess, with the exams. Oh, yeah, I want to talk about those too. With the exams, um, it does have the answer selected, which is
Yeah.
good. And if there was like a little bit of an explanation, that would help. But
I'm working on that. Yeah.
the thing I think I'm looking forward to, if you somehow get them out, is that simulated exam you were talking about on your
Yeah.
page.
I'm putting it together. I actually took exam 3. I don't know if you noticed it, but I took exam 3 and I did take out all the highlighted answers. It's right below the exams. You can
Okay.
click on that and you can take exam 3 if you want to test yourself.
Okay.
I don't like people doing that.
Yeah.
Yeah, I mean, I don't know if I explained that to you, but yeah, if you test yourself, you read the question, read all the answers, you think about it, you pick what you think is the right one, and when you pick it, you just imprint it in your brain. That's the answer goes to that question, and you'll hold
Yeah.
on to that, even though you grade it, you got it wrong. The next time you see the question, you typically will pick the same wrong answer. So, but I've got people asking. I'm like, okay, it's out there. My recommendation is don't, but I'll cater to it. But yeah, I'm still putting that one where, yeah, she did, one of the gals, she actually went through and just gave me a barrage of questions out of each of the exams that I'm putting together, and I should have it posted probably by the end of this weekend. I started, compiling the questions and putting them together. So soon, Mark, soon. Okay.
Yeah, with the simulated exam, I guess the thing I do like about it, a simulated style exam is, of course, I'm kind of participating more than just kind of like looking at it and reading it over and over again, like I'm
Yeah.
actually trying to, come up with the solution myself. And I like the action of something like that,
Yeah.
I guess, for me. But.
Got it. Okay. All right. Yeah. So I'm working on that, and hopefully I will have that out pretty quickly. So yeah.
Sweet, sweet.
All right. Samuel, you still there?
He fell
Everybody else
asleep.
failed.
Yeah,
We had up to 6 people that dropped in and then dropped out. So yeah. Okay. Well, I guess we will call it a night. Thank you for showing up.
thank
And
you.
again, don't hesitate to reach out. Good luck, sir. And again, we'll be in communication, I'm sure. So not a problem.
Okay, thank you so much.
You got it. Have a good night, everybody. Bye
You
bye.
too. Bye.